Hey, what's going on YouTube? Welcome back. It's Travis with special guest star Julie here from JT Wealth. And in today's video, we are going to do an update on our dividend investing series now that we have reached just over a year mark from the original time Julie created this video series for you guys. So let's get into it. All right, like I said, welcome back everybody, and thanks so much for checking out the channel. If you don't mind, take 2 seconds out of your day and hit that big thumbs up like button and consider subscribing to the channel if you haven't already. And since this is a dividend focused video and we keep our dividend portfolio with M1 Finance, if you're looking to start your own dividend portfolio to either track along with ours or just create your own, consider checking out the link in the description section down below where you can get free cash just for signing up and funding your account.
And guys, like Travis said, it has been 1 year since we started this dividend investing portfolio. Now, the whole point of this series is to show you guys how contributing a small amount week after week can add up and eventually lead to that goal of passive income. So with this investment portfolio, we decided to start out with $50 every single week going into a mix of dividend paying funds. Now, if we stick with this plan over the long term, I'm talking 20 to 25 years, we're going to build up a nest egg that we can then draw passive income of $2,000 or more. So this is obviously not a get rich quick, but it's to show you the magic of that compound growth and how starting with even a small amount can make a big difference over the long term.
All right, so why should you care about dividends so much? Well, 5 of the primary reasons why dividends matter for investors include the fact that they substantially increase stock investing profits, provide an extra metric for fundamental analysis, reduce overall portfolio risk, offer tax advantages, and help to preserve the purchasing power of your capital. Some of the key takeaways are that companies that issue dividends can provide inherent fidelity to the financial state of the company. Unhealthy companies are generally not in a position to provide dividends to their shareholders. Qualified dividends paid are taxed at rates lower than the ordinary income tax rate of 0 to 20%. And even during periods of recession, dividend stocks have historically shown growth. Now, this is something I think is huge. 75% of the returns from the S&P 500 from 1980 all the way up to 2019 came from dividends alone.
That last point brings me to the importance of DRIP, or the Dividend Reinvestment Plan. Now, this is where you can automatically have those dividends paid out by companies reinvest back into that stock. This is where that compound interest really takes flight. So it is a huge component to a dividend investment portfolio. Now, I know I already kind of mentioned our passive income goal, but I want to show you some of the numbers behind that calculation. So here is the dividend calculator we used originally when we started this investment account. It shows our annual contribution of $2,600 per year, which is that $50 per week. We have a small annual dividend increase in there, as well as our appreciation of our share value, which we averaged out over historical returns for our holdings. This will show you an annual dividend income of nearly $24,000 after a 25-year investment period.
All right, so let's take a look at exactly where the portfolio stands today. And the aptly titled JT Wealth Dividend Portfolio sits at about $3,370.92, which shows a gain of $657.88, split between the market gain of $590.85 and the earned dividends so far of $67.03.
Now, this dividend portfolio consists of 12 different stocks, as we didn't want to overpopulate and get it too crowded in there. So we really focused in on some solid dividend paying companies.
In that 12 stocks, we have included Pfizer, Realty Income Corp, AT&T, SPHD, which is the Invesco S&P 500 High Dividend Yield ETF, Coca-Cola, and Navient Corp. Of all of those 6, Navi has definitely outperformed the rest and is our highest performing stock thus far. The last 6 include Walgreens, JP Morgan & Chase, AbbVie, Shaw Communications, Cisco Systems, and 3M. And just to show you guys how the actual portfolio has done overall, we're up 21.35% on the year, showing a cost basis of over $2,700, but a current value of over $3,370.
I just want to add that during a bear market, dividends can be a great hedge against risk, as they'll provide that consistent income even when markets are down.
And it's also worth mentioning that M1 Finance has a lot of fantastic tools to help you guys decide where you want to invest your money. Say you don't necessarily want to follow the dividend plan, or maybe you're trying to make your own retirement plan. They have tools and options that will help you do that on your own. So when you log into the main M1 screen, you'll see options like stocks, funds, your pies, and expert pies. When you select the expert pie option, you'll get the screen that looks similar to the one you're looking at now, where you can choose between general investing, retirement, responsible investing, income earners, hedge fund followers, or just stocks and bonds. And if you're, say, somebody following a FIRE plan and you're trying to set your own retirement plan, click on the plan for retirement and this is what you'll get. You'll find target date plans for any timeline and any risk tolerance. So you can select your planned retirement date and decide whether or not you want to be aggressive, more conservative, or a very moderate investor, and they'll help you set up a retirement plan that fits into your category and your portfolio preferences.
When I worked as a financial advisor, plans and target date investments like this were a client favorite, as they really were a set it and forget it plan. There are asset managers who are rebalancing constantly, so you don't need to worry about managing your own portfolio. Just worry about setting up that automatic investment week after week and then let it go from there.
And if you do decide to create your own portfolio, but want to use those dividend payments as passive income in retirement, there are ways to set this up. Most dividends pay out quarterly, but there's only 4 quarters in a year. So there are ways to buy certain stocks to make sure you are receiving your dividend payments monthly. This image shows a possible way you could do that. There are others, but in order to get paid monthly, you could use these companies who pay out either January, April, July, October, or February, May, August, and November, or March, June, September, and December. And you would just pick one from each to make sure you are getting paid every single month. Obviously, having more than one would be beneficial, but this is a way around not having monthly paying dividend stocks and still being paid every single month.
So that is an update for our dividend investing series. I can't believe it's been over a year now since we began this. So please let me know in the comments down below if you've been following along or what type of dividend investing plan you have going. We always love hearing from you guys. Please make sure that you subscribe to the channel and give a thumbs up if you made it all the way to the end here. Thank you guys so much for watching, and bottoms up.
Big, scary pibble. I'm not. Sorry, man.